So we welcome you to today's conversation in entrepreneurship, where we are looking at this fifth unit, where we focus on looking at the business finance part of it. We need to learn how to finance the businesses. So it is very important, extremely important that at the end of the training, you should be able to learn about the cost of starting an enterprise, know the different sources of finance to start a business venture, should be able to understand the meaning of leasing finance, learn microfinances, understand the crowd funding, know microfinance, and learn about traditional financing here in Zambia. So that is what is there. Those are some of the things we expect you to learn at the end of this conversation. Okay. So the permanent capital, what about the permanent capital now? So the permanent capital base of a small firm usually comes from equity investment in shares in a limited company or share company, or personal loans to form to form partners or to invest in sole proprietorship. So it is used to finance the start or up cost of an enterprise or the major developments and expansions in its life cycle. It is actually required for a significant innovation, such as a new product development, to ensure that you appreciate the idea of ensuring you have permanent capital. So equity is usually from the private investors. Okay, let's talk about the equity that is coming from the private investors. So it may also be sought to take, let's say, it can be sold to take a small firm into the medium term or large size category. Yeah, that's what usually happens. So permanent capital is very, very important for the business. There is also what we call the working capital. So this one is usually a short-term finance. So most small firms need working capital to bridge the gap between when they get paid and when they have to pay their suppliers and their overhead costs. So the requirements for this kind of short-term finance will vary considerably by business type. So for example, a manufacturer or a small firm selling to other businesses will have to offer credit terms, and the resulting data will need to be financed. Okay. So the faster the growth, the more the data and the larger the financial requirement. So a retailer or a restaurant, a public house or other type of outlet selling directly to the public will often collect cash with the sale. However, okay, ends the cash flow will be, let's say the ends cash flow will be advantageous for them. So it's a good thing for them to sell on cash, but sometimes again, you find that it is very difficult as the company grows or as the business grows to sell on cash. Mostly the data will be unavoidable. So all you need to know is just how to manage the data, since you may not manage to do away with them. Asset finance, it is actually a medium term. Okay, it is a medium term. That's a you usually use this kind of finance in the period that is medium to the one that is long. Okay. So the purchase of a tangible asset is usually financed on a longer term basis from 3 to 10 years and more depending on the useful life of the asset. Okay. So plant machinery, equipment, fixtures and fittings, company vehicles and buildings may all be financed by medium or long-term loans from a variety of lending bodies. Let's briefly talk about now the sources of financing. Where do you get the sources of finance? So the sources of finance are usually broken down into two. There are those what we call internal sources of finance and the external sources of finance. We start with the internal sources of finance, right? So Owner's capital or owner's equity does represent the personal investment of the owners in a business, and it is sometimes called the risk capital because these investors assume the primary risk of losing their funds if the business fails. So that is what is there. So the common sources of internal finances include personal savings. Okay. So first place, the entrepreneurs should take for startup money. Usually what happens is that they save their own money. Usually they start businesses using the money that is in their own pocket. And now the general rule, entrepreneurs should provide at least half of the start-up fund in the form of equity capital, right? Should be able to fund the business. Friends and relatives. After emptying their own pockets, entrepreneurs should turn to friends, relatives who might be willing to invest in the business. So the entrepreneur is expected to describe the opportunities and threats of the business clearly. From partners, as an entrepreneur, you can choose to take on a partner to expand the capital formation of the proposed business. You can still get stock, let me say, finance from the public. In some cases, entrepreneurs can go publicly by selling shares of stock in their corporation to outsiders. Okay. What are angels? All right. So now these are private investors, right? Who are wealthy individuals, often entrepreneurs who invest in the startup business in exchange for equity stake in these businesses. They are there. They are willing to fund in this small business and they want it to keep on going. Venture capital companies are private for-profit organizations that purchase equity position in young business expecting high return or high growth potential opportunity. Right. So these are some of the, the common examples or the sources of internal finance. What about external finance? Okay. External finance. Now, look, borrowed capital or debt capital is the external financing that small business owner has borrowed and must repay with interest. There are different sources as discussed here below. Number one, we have commercial banks. So I'm talking about the external finance. So commercial banks are there. They're usually the most frequent, lenders of short-term debt to the entrepreneurs. Okay. That is what they usually do. So you need to provide a security to the bank, which is a collateral. Then they are able to give you that money. Okay. Now, to secure a bank loan, an entrepreneur typically will have to answer a number of questions together with descriptive commentaries. For example, what do you plan to do with the money? That is very important. The banks will not give you the money when they are not sure of what you're planning to do with that money. When do you need it? How much do you need? How long do you need the money? And how will you repay the loan? That is very, very critical. Yeah. So now, when it comes to the issue of the banking lending decisions, now, the small business owner needs to be aware of the criteria bankers use in evaluating the credit worthiness of a loan application. So most bankers refer to the 5 C's of credit in making lending decisions. And the following are the 5 C's that the bankers usually pay attention to. Number one, capital. So a small business must have a stable capital base before a bank will grant a loan. Otherwise, if you don't have a stable capital base, the bank will not grant a loan. Number two, capacity. The bank must be convinced of the firm's ability to meet its regular financial obligation and repay the bank loan. Collateral. The collateral includes any asset the owner pledges to the bank as security for repayment of the loan. So character. Character is the 4th C that we discuss in here. Before approving a loan to a small business, the banker must be satisfied with the owner's character. So the evaluation of the character frequently is based on intangible factors such as honesty, competency, willingness to negotiate with the bank, among others. The fifth one is the conditions, right? So the conditions surrounding a loan request also affect the owner's chance of receiving funds. So banks consider the factors relating to the business operations, such as the potential growth in the market, competition. They look at the competition. They also look at the location, okay? And they look at the loan purposes. Those are some of the things, okay, to consider. Now, the higher a small business scores on these 5 C's, the greater its chance will be of receiving a loan from the bank, okay? Microfinance. What about microfinance? The microfinances provide financial services mainly to the poor, micro, and small enterprises, okay? That is what the microfinances do. The trade credits, okay, is also external source of external funds. So with the trade credits, it is a credit that is given by suppliers who sell goods on account, okay? This credit is reflected on the entrepreneur's balance sheet as an account payable. And in most cases, it must be paid within 30 to 90 days or more days. Credit. When you buy things on credit from your suppliers, it's also a source of finance. Equipment suppliers. Most equipment vendors encourage business owners to purchase their equipment by offering to finance the purchase. Account receivables financing. It is a short-term financing that involves either the pledge of receivables as collateral for a loan. Credit unions. The credit unions are non-profit cooperatives that promote savings and provide credit to their members. But the credit unions do not make loans to just anyone, okay? So to qualify for a loan, an entrepreneur must be a member in the credit union. The other source are the bonds. So a bond is a long-term contract in which the issuer, who is the borrower, agrees to make principal and interest payment on a specific date to the holder of the bond. So the bonds have always been a popular source of debt financing for large companies in the Western, and still also here in our country, still that happens. So that is what usually happens. Those are some of the sources of external financing. It is very, very important that you understand. Now, what about the leases? Now, even a lease is also a part of financing, a source of finance. Now, leasing finance is one of the most important sources of medium and long-term financing, where the owner of an asset gives another person the right to use the asset against periodical payments. So the owner of the asset is known as the lessor, and the user is called the lessee. So the periodical payment made by the lessee to the lessor is known as the lessee rental. So under the lessee financing, lessee is given the right to use the asset, but the ownership lies with the lessor, and at the end of the lease contract, the asset is retained to the lessor, and an option is given to the lessee either to purchase the asset or to renew the lease agreement. That is what happens. So it's just more like a rental. You're just renting an asset that does not belong to you. So you're paying some rental payments. And at the end of the agreement, the agreed period, you decide whether to buy the asset or just renew the lease so that you can continue paying rentals. Types of leasing. Okay. The first type of lease is called the finance lease. So with a finance lease, it is the lease where the lessor transfers substantially all the risks and the rewards of the ownership of an asset to the lessee for lessee rentals. Okay. In other words, it puts the lessee in the same condition as he or she would have been if he or she had purchased the asset. Okay, so they take all the responsibility, maintenance, all the responsibility, all the risks available. If there is a problem with an asset, they have to repair it, everything. Okay, that is a finance lease. But there is also what is known as an operating lease. Okay, now an operating lease. Okay, here we find that the leasee, this is actually this is a lease other than financing lease, the operating lease. Here what happens is that the risks and the rewards incidental to the ownership of an asset are not transferred by the lessor to the leasee. Okay, so the term of such lease is much less than the economic life of the asset, and thus the total investment of the lessor is not recovered through leasee rental during the primary period of lease. So in case of an operating lease, the lessor usually provides an advice to the leasee for repair, maintenance, and technical know-how of the leased asset. And that is why this type of a lease is also known as a service lease. What are some of the key notes about the operation lease? Number one, the leasee, the lease term is much lower than the economic life of the asset. Then the leasee has the right to terminate the lease by giving a short notice, and no penalty is charged for that. The lessor provides the technical know-how of the lease asset to the leasee. The risks and the rewards incidental to the ownership of an asset are borne by the lessor. That is what usually happens. Are there advantages? Okay, advantages of lease financing. Number one, assured regular income. So the lessor gets lease rental by leasing an asset during the period of lease, which is assured and regular income to that one who is leasing, of course. Preservation of ownership. In case of finance lease, the lessor transfers all the risk and rewards incidental to the ownership of the asset to the leasee without the transfer of ownership of an asset. You just transfer the risks and the rewards, not the ownership. And that is what happens. Okay. Then other benefit is that the benefit of tax. So under here, as ownership lies with the lessor, tax benefit is enjoyed by the lessor by way of depreciation in respect of the leased asset. High profitability. So the business of a leasing is highly profitable since the rate of return is based on the lease rental. Okay. High potential growth. There is high potential growth for the same lease payments. Right. Are there any limitations? Any limitation to the lease financing? Number one, unprofitable in case of inflation. So the lessor gets a fixed amount of lease rental every year, and they cannot increase this even if the cost of asset goes up. That is what happened. Double taxation. There is a sales tax. The sales tax may be charged twice, first at the time of the purchase of the asset, and at the second at the time of leasing the asset. Still, you have to pay tax. Greater chance of damage of an asset. So as the ownership is not transferred, the lessee uses the asset carelessly, and there is a great chance that asset cannot be usable after the expiry of primary period of a lease. So those are some of the disadvantages of the lease. What about the crowding fund, the crowdfunding? So now, crowdfunding is a method of raising capital through the collective efforts of friends, family, customers, and individual investors, or even from the general public. This approach taps into the collective effort of a large pool of individuals, primarily online via social media, crowdfunding platforms, and leverages their networks for greater reach and exposure That's called crowdfunding. Use a lot of people bring in their resources. Now, it is very important to look at the different types of crowdfunding. Okay, the different types of crowdfunding. Number one, donation-based crowdfunding. So broadly speaking, you can think of any crowdfunding campaign in which there is no financial return to the investors or contributors as donation-based crowdfunding. So common donation-based crowdfunding initiatives include fundraising for disaster relief, charities, non-profits, and medical bills. Reward-based crowdfunding. The reward-based crowdfunding involves individuals contributing to your business in exchange for a reward, typically a form of the product or a service service to your company, sorry, let's say a service that your company does offer. Usually that happens. Now, even though this method offers the backers a reward, it's still generally considered a subset of donation-based crowdfunding since there is no financial or equity return. The third one is called the equity-based crowdfunding. So unlike the donation-based and the reward-based methods, equity-based crowdfunding allows contributors to become part owners of your company by trading capital for equity shares. So as equity owners, your contributors receive a financial return on their investment and ultimately receive a share of the profits in the form of dividend or distribution. Microfinances. So the microfinance is actually a term that is used to describe the financial services such as the loans, savings, insurance, fund transfers, okay, to entrepreneurs, small businesses, and individuals who lack access to banking services with high collateral requirements. So essentially, it is providing loan, credit, access to savings account, or even insurance policies and money transfers to small business owners, entrepreneurs. Right. That's about the microfinancing. So it is very, very important. Microfinance is important because it does provide resources and access to capital to the financially underserved, and such as those who are unable to get checking accounts. Okay, it is very, very important to have those, and they are very, very important. They help the young entrepreneurs. So basically, this is what we had in this unit, which is business financing. At least you have learned something about how to finance a business. Is there any question? All right.